Hi, in this video we're continuing with our series on sources of risk within financial assets, and we're looking at macroeconomic risk today, also known as macro risk. So what is macroeconomic risk? Well, it is where asset values may change due to shocks to the economy. Any assets that are exposed to a particular economy may be affected by changes to that economy. For example, if the US economy has very weak economic growth, a lot of US stocks are going to perform poorly. However, a lot of UK and European stocks will also perform poorly because these companies have lots of exports going to the US. So your asset doesn't have to be physically in this economy or listed on its stock exchange to be exposed to macroeconomic risk within that economy. So there is always a risk that a certain economy will run into trouble. There are lots of reasons that this can occur, whether it be due to the government or something completely out of the government's controls. So here are some possible risks that we may include under the umbrella of macroeconomic risk. So we could have changes to fiscal policy, so what the government is just choosing to do in terms of, say, tax policy, government spending, or regulations on businesses. We can also have changes to monetary policy, such as the central bank changing interest rates or increasing or decreasing quantitative easing measures. These two changes in policy can have a large impact on macroeconomic conditions. We can also see changes to exchange rates, and this may be due to a change in, say, monetary policy, but it could be for other factors out of the government's control. For example, changes in a different economy, which mean that the domestic currency changes. So say if a different currency appreciates or depreciates against our currency, this can still have an impact on our economy. We could also see changes to commodity prices. Say if a country is very reliant on oil exports, then if the price of oil massively decreases, for example, because we currently have we're moving towards regulations which look at protecting the planet and reducing climate change, so oil prices may be affected by that. Then if your economy really relies on this resource, a reduction in commodity prices is going to, massively harm your economy. And so this is a risk of economies that are dependent on oil. All of these factors can lead to reduced economic growth and increases in unemployment within an economy. And both of those, again, are going to potentially affect asset values within an economy. If we have our economy with really poor economic growth, but perhaps it's in recession, a lot of stocks and various assets within that economy are going to decrease in value, and similarly with unemployment. And just a point to note here that certain industries may struggle more than others in response to macroeconomic risk. And this ties into industry risk, which we're going to look at in a different video where specific factors will affect certain industries more. But we are looking at sort of macroeconomic changes which will affect the whole economy, but certain industries and thus certain assets within our economy will be affected more than others by these factors. So there are various measures which we can use to give us an indication of macroeconomic risk. So how do we actually measure this? And we won't go into this in much detail because I'm just giving an introduction. But the fact is, we may think, all these change, like a change to policy, change to exchange rates, we can't necessarily predict them, but actually we can, and there are ways that investors will use in order to measure how much macroeconomic risk there is within a country, and thus this will then factor into the asset prices. How likely is it that we face one of these risks that is going to decrease the values in the future? So one of these, there are, say, rankings of the political stability of different countries that investors can use to say, okay, if I look at, say, the USA, the United Kingdom, major European economies, these are potentially more politically stable than, and that's the next point, than, say, developing countries, which may have, say, civil unrest within the country. There may have recently been a change of regime. There may have been, say, a rebellion that has caused a change in regime. And these sort of changes in governments obviously make it much more likely that we're going to see big shifts in policy which could have a positive or a negative effect on asset values. We often see that they will have a negative effect because we're just uncertain about what's going to happen within an economy. So this is one reason why less developed economies often have higher macroeconomic risk than developed economies. Maybe they don't have the institutions, the regulations in place such that there's as much stability within the economy. And this can mean that they have the opportunity to grow very quickly, but it also means that there is the risk of, policy changes that are very negative for asset values. And investors do tend to err on the side of caution. So if there's instability within an economy, we tend to see this as being reflected negatively in asset values. So that will wrap up this video on macroeconomic risk. If you found it useful, please do give this video a like rating, check out the series for the other macroeconomic risks, and subscribe to add some econ to your subscription feed.